need folks to know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So with that disclaimer out of the way, I'll bring Joe up with the GME DD account. I know he's going to stream the call once we get to 5 o'clock. Just wanted to give a little Wook overview for folks. I'm sure some of you have seen the account floating around. Wook Capital was really founded on the novel thesis that the crowdsourced research experience that the founder, John Kim, and I shared in 2020, leading to the GameStop investment thesis. John ended up being one of the largest individual shareholders in GameStop before exiting the position in January 21. And as a byproduct of all of the work and time we spent together on StockTwits Discord, Seeking Alpha, and he and I were active in the Roaring Kitty, Keith Gill's YouTube streams. We basically walked away, both of us really impressed by how much retail can really, I think, outperform in terms of information gathering some of the moneyed powers that exist out there. So while Wook is a private investment fund, I think our fundamental thesis is that working with retail investors, we can all achieve something greater together, and that's our hope. We're not selling any service. We certainly are hoping to foster and build a community over the years to come, but that's a very long road to hew. So in the interim, we hope to share useful information that people can consume free of charge, no obligation to do anything with it. Our intention is simply to share information and to build a social gathering place for retail investors that are intent on growing and learning as investors. And with that shtick out of the way, again, I'm Rod Alsman. I'm the managing director at Wook. And while Wook and I personally don't have positions in GameStop, obviously it's near and dear to our hearts as it led to the work that we are able to work toward today. So GameStop reported earnings after the close today. There's, I think, several different things I want to touch on before we get to 5 and potentially bring other folks up. Just from a pure results perspective, I would say they're lackluster. The revenue expectations from Wall Street were about a 10% miss, the actual revenue result. Obviously, that's the top line before you account for any expenses. The company noted in the press release that they're selling general and administrative expenses, which had been elevated in previous quarters. If you follow GME DD, you've likely seen some of the headcount reductions that they've been going through. So the company noted in their press release that sequentially that SG&A was down from, it was a 14.3% sequential reduction. Now, granted, SG&A is up year over year, so I think it's safe to say SG&A should continue to trend down as the impacts of all of those cost-saving initiatives flow through in subsequent quarters. But the math ends up being that on their revenue, they only had gross margins of about 25%. So the direct costs of the software, collectibles, and hardware that they sold led to 25% gross margins. And then when you look at the selling, general, and administrative margin, or percent of sales rather, that's about 30, 34, 35. So that leaves them with a bottom line loss of about 10% of sales. But they're taking cost out of this model that they obviously invested a lot into in the past year and a half in terms of improving e-commerce capabilities. They've obviously built out a blockchain team and some early capabilities there. There was, of course, now this concurrent news at the close with GameStop forming a partnership with FTX. FTX is Sam Bankman-Fried's crypto vehicle, centralized exchange. It was very sparse on details. The statement simply reads, the partnership is intended to introduce more GameStop customers to FTX's community and its marketplaces for digital assets. In addition to collaborating with FTX on new e-commerce and online marketing initiatives, GameStop will begin carrying FTX gift cards in select stores. During the terms of the partnership, GameStop will be FTX's preferred retail partner in the United States. So they didn't disclose any of the financial terms of the partnership. To me, it's more headline than game changer, if you will. At this point, we will have to see what comes of it. Obviously, GameStop's NFT marketplace is still in a beta-like format. They rolled out a GameStop wallet in the quarter as well. So those products have come to fruition, and if you're a long-term crypto slash blockchain slash NFT bull, you may welcome this news. It does seem that the market, at least in after hours, is welcoming the news. The stock is trading up about 10% presently at 440 Eastern. So that's a pleasant change for those of you who've been in GameStop earnings calls previously. I think it's a rite of passage for the stock to get pounded after earnings calls. So if this is your first one, this is a pleasant starter. But if you've been around a while, this is certainly different than the norm. So, okay, we got the financial results. We got the partnership announcement. The one other aspect of the financial results that I'll cite, which the company put in its second bullet point, and I've noted previously in a variety of venues, that there is an opportunity in their physical collectibles business, which does dovetail with the digital collectibles opportunity. So they noted that collectibles sales were 223 million in the quarter, and that's up from 177 in the prior year. So a 26% improvement in collectibles sales. So I would say it's pretty safe to assume the company will exceed 1 billion in collectibles related revenues through year end, given the bulk of sales come in the fourth quarter holiday gifting period, which is, I think, the real vector that investors should continue to monitor. Obviously, software has continued to be weaker than I think myself and many who were bulls had expected preceding the console releases in November of 2020. There's been a lot of different delays in software launches for the past year and a half or so. And there has been a shift to Game Pass, and now Sony, of course, has rolled out an enhanced offering for PlayStation Plus. So the paid streaming subscriptions do seem to be taking more of the software share, perhaps, than had been expected. And then couple that with delays in new product launches and somewhat lackluster. Personally, I only find myself using my PlayStation 5 for Elden Ring, and I bought the thing in pretty much when it first came out. So while the hardware is pretty impressive, the amount of software that I've personally paid for seems to be less than it was in previous cycles, and it seems that that may be true broadly. So collectibles, I think, is the bright spot. Hardware and accessory sales were down year over year as software declined meaningfully, as I noted. So continue to watch the pace of the mix shift from software toward collectibles at some point in the not so distant future. Right now collectibles are 20% of sales in the quarter, and software was 28. At some point in the not so distant future, you'll see collectibles be a larger business line than software, I would venture. It's just a matter of when, not if. And so that's kind of the operating results. Not much from the company beyond that. They did note that they are implementing SAP from an ERP perspective, which does seem to fly in the face of the news that they were going to be adopting Dynamics 360. But that was from the prior management team, and it does seem that this management team has done away with a lot of the prior management team's courses of action. The inventory levels are also a bit higher. Again, the company calls out a desire to maintain adequate in-stock levels. I know I've shared previously that I tend to go to stores occasionally, and I had noted the times that I went during the quarter that inventory levels seemed robust, in fact, too high. I know that one of my local stores was running a clearance offer at one point during the quarter. So, seeing gross margins down under 25%, it does seem like part of it is a desire to drive customers in who may have forgotten about them or who may not have done business with them for some time. Obviously, this FTX announcement may bring new customers to GameStop, younger customers who are more digital natives. So it remains to be seen what opportunities there are from that perspective. I would add, and I know a lot of the more meme investment oriented folks are interested in the directly registered shares. So the 10Q came out and reflected 71.3 million shares of directly registered stock as of July 30th, and that compares with 12.7 in the prior quarter. Obviously, there was a 4-for-1 split in the interim. So the adjusted share count reflects basically a 40% quarter-over-quarter growth in direct registered shares from 12.7 was the prior. So the adjusted would be 17.825. So it's actually a pretty meaningful increase. I mean, at the end of the day, that means nothing from a business value and fundamental cash generation perspective. It does mean the price may be supported by that to an extent. But that remains to be seen how durable that will be. But it's yet to tick down quarter over quarter. So interestingly, we're now talking about on a percent of shares outstanding basis, about 23.5%, if my math is right, of shares outstanding are directly registered with their transfer agent. So that number continues to go up. It's about 23%. Sorry. There's been some dilution. So, it remains to be seen what that means. It means that there's a large swathe of investors out there that are certainly enthusiastic enough that they've opted to directly register their shares and in pursuit of whatever that means. So wanted to call that out. I haven't gone through the entire queue yet. I don't know if anyone has seen any notable changes to the 10Q or in the 10Q beyond that. Again, just to summarize, I think you could say good result on collectibles, poor result on software, overall a weaker revenue line, which I think should have probably expected, right? This is a consumer discretionary stock. The economy does appear to be slowing and consumers are getting pinched. In particular, GameStop does tend to attract consumers that may be seeing more of their discretionary dollars sucked away from higher food and fuel bills. So depending on where those things trend going forward, if fuel prices continue to decline, if inflation in the food space continues to maybe plateau or decline, that could give more discretionary dollars to the GameStop consumer. But it does appear that it will be a challenging environment for them. They're going to be battling with every other consumer goods seller in the third and fourth quarters, and there is a lot of inventory out there. So while they are stocked, they may end up not getting the highest of margins if they end up having to discount to draw traffic. But we'll see. They obviously have a much improved balance sheet from pre-2021. There is no debt, but for small, I think it's interest-free French loan, and their cash position is still substantial, although they did consume in the 6 months ending a bit under 407 million in cash was used in operating activities. So that's certainly not a sustainable run rate for them. A portion of that was an increase in working capital because of the elevated inventory levels. However, it's not sustainable. The rate at which they're losing money still on the bottom line. They're still using cash in their operations. They are better situated than many other retail peers. However, when you consider the clean balance sheet, that's obviously puts them in a better spot than someone who might be leveraged and facing cash generation and debt repayment concerns. So they do still have a $500 million revolver, and of course can flex that as needed if they need to ramp inventory levels even higher. But yeah, it's 448. So hopefully that's a decent high level overview of the results. When we get to 5, I'm going to mute myself, and Joe is going to open up the call, and we'll play the earnings call live, which, based on the past precedent, will probably run anywhere from 5 to 7 minutes. We'll see. With the intention that we will welcome folks to come on up who may want to chime in, add their thoughts, ask any questions they may have. We'll look to wrap, depending on how long the call does in fact go, maybe around 5:30, 5:45. So again, this is being recorded. If you missed the disclaimer at the onset or missed my entree, we will have this posted to Wook's social media channels. We do have a Wook Capital YouTube channel where you can find this, as well as any other programming that we record going forward. There's some programming there now, so you can find this Twitter Spaces both on Twitter and on our YouTube after we wrap today. So with that, 10 minutes until the call kicks off. I don't know if anyone who's in the audience had seen anything differently in the 10Q or wanted to chime in. Again, I think in a nutshell, it's SG&A costs are sequentially improving. Collectibles continues to show strength. They've moved forward with the launch of the digital wallet and the NFT marketplace, and now solidified this partnership for whatever that means with FTX, and remain with over 900 million in cash. So that does, again, put them in a situation where they're not at risk of insolvency anytime soon, although at the rate they're burning cash, that runway may run out within the next few years, assuming the underlying business does not improve. And as I mentioned, the direct registered share count is up quarter over quarter meaningfully, and now represents about 23.5% shares outstanding. Mr. Alpha Hunt, my friend, how are you, sir?
Sorry about that. Forgot the mute button. Doing well. Thanks for asking. Hope you're doing the same. And as always, again, thanks for hosting these. These are really fun and educational. So we saw a meaningful reduction in SG&A. Obviously, there were a number of layoffs during the quarter. Just speculating here, looking for your sense. Do you think that's enough? Do you think there are more layoffs coming? Do you see any other opportunities to reduce SG&A? Really, any take you have there?
We got the news, right, that they're going to begin to incentivize the store, frontline workers with some equity compensation, which I think is a good thing, even though it might not have been clear to the rank and file workers precisely what it meant. If all else equal, an improvement in compensation is, I think, a good thing for them, and would be good for the company if it aligns them with providing exceptional customer service, which is really what it boils down to. I know that SG&A does have transformation initiative cost, and I'm looking for their breakout. If I remember correctly, they do include, so they include transformation costs, significant transactions, divestitures in their SG&A to adjusted SG&A bridge. So the transformation costs for this year were minimal. They didn't recognize any other adjustments for SG&A. So I guess what I'm saying is it's kind of unclear, right? None of us can see behind the curtain. We don't work there. it's good to see that the sequential improvement occurred. It's unclear what the normalized cadence of SG&A will be net of all of those cost takeouts, and I doubt that management will provide clarity on that. And the other thing to remember is, given how seasonal the company is, it's not, even if we see them get to a steady state of ongoing profitability, it would not surprise me to see slower quarters like the second quarter show operating losses, because they're going to have a very comparable cost structure in the second quarter and fourth quarter. Obviously, fourth quarter, they'll have more extra staff in the stores. But if you think about their fixed costs, those aren't going to change intra-year. So they're going to have those same fixed costs that they spread out over the 4 quarters. And GameStop has historically, among all, they were at one point Fortune 500, but of all the Fortune 500 at the time, they were, I think, the most seasonal, in that 40-ish% of revenues came from the fourth quarter. So because of that, it's always hard to say on just a 1 quarter snapshot basis. I think it will be very important to see how the fourth quarter of this year goes, this holiday, right? I mentioned earlier, I think that there's going to be a lot of competition for consumer dollars, because the consumer is not as healthy as the consumer was last year, and on the heels of all the fiscal stimulus that was pumped into consumers' wallets. So we'll see. Gross margins were pretty bad last fourth quarter, if I remember correctly. It was maybe 22%, something like that. And if they could get any sort of gross margin improvement, which you could and should see some improvement from mix, collectibles are higher margin. So if they continue to grow collectibles, that should help. Although losing pre-owned sales, which we know they don't break out the pre-owned portion of software, hardware, and accessories anymore, and they haven't for a few years. It's safe to assume that pre-owned continues to decline based on margins continuing to compress. And as I was kind of saying anecdotally, it doesn't seem like there's been as much physical software sold for this current generation yet. I know Sony does break that out further in their supplementals, and I'd be lying if I said I've been as obsessed with it as I was in 2020 and early 21. But I do believe that the mix shift from physical to digital had accelerated. And again, it goes back to the maybe dearth of new programming. I would say SG&A, just remember that GameStop kind of will always maybe lose money in its low end quarter just because of the seasonality, which the shift to collectibles, right, should help buffer that a little bit, but it's still very much a seasonal gifting related business.
Thanks for that. That was really insightful.
Yeah, so we got 4 minutes till the call is going to kick off. Trying to, let's see, I assume Joe has the call ready to go. And once that starts, I'll mute myself and we'll play this through the audio here. I'm reading the SG&A section in the queue right now, so I'll just read it aloud. Super exciting. During the 3 and 6 months ended July 30th, 22, SG&A increased 8.6 and 90.5 million, respectively, compared to the prior year. So that kind of shows you how much it improved in at least the first half year over year. And that gets back to the point of how much of that is transitory SG&A or elevated SG&A from over hiring. We talked about the headcount reductions. So without getting clarity from management, it's really hard to know what is a run rate SG&A going forward. Those SG&A expenses as a percent of sales were 34.1 and 33.4% in the 3 and 6 months, which again, if your gross margin is 25 and your SG&A is 34, you're losing money on everything you sell when you load in those labor and overhead costs. But again, that's where you need the top line to grow and to get more gross profit dollars that you can spread across that SG&A. They do note SG&A expenses increased primarily due to costs associated with transformation initiatives, which included labor costs as the company insources talent and investments in technology to support growth. The increases were partially offset by the net impact of certain digital asset-related activities, lower marketing costs, and the continued benefit from lower store occupancy costs as a percent of sales driven by prior year cost reduction initiatives. The 6 months ended July 30th, 22 were also impacted by digital asset impairment charges incurred during the first quarter of 2022. Okay, so this is another thing to remember. Anytime you're dealing with a company that owns digital assets, whether it's Ethereum, IMX, Bitcoin, those are those are intangible digital assets that the way the accounting works is as the price goes down, you have to mark the asset down. But when the price goes up, there is no mark to market on the upside. You would only realize a gain if you sold the digital asset. So that digital asset noise could also be bloating SG&A. And I don't know that they provide enough disclosure without really digging in the weeds to get to a clean answer there. So a little more color on SG&A. But with that, it's 4:59. Joe, I have the call up on my computer, and I hope you have it up on yours. And I'm going to pause there and let you play so we can hear the lovely elevator music while we wait.
Good afternoon and welcome to the GameStop second quarter 2022 earnings conference call. Please note that certain statements made during the call constitute forward-looking statements made pursuant to the safe harbor provisions of the Private Securities Litigation Act of 1995, as amended. Such forward-looking statements are subject to both known and unknown risks and uncertainties that could cause actual results to differ materially from such statements. These risks and uncertainties are described in the company's earnings press release and its filings with the SEC. The forward-looking statements today are made as of the date of this call, and the company does not undertake any obligation to update the forward-looking statements. I will now turn the call over to GameStop CEO, Matt Furlong.
Thank you, and good afternoon, everyone. I want to begin by reiterating the deep appreciation we have for our stockholders' unrivaled enthusiasm, passion, and support. As we work to transform GameStop, these remain unique tailwinds for us, ones we always recognize and value. I also want to take this opportunity to thank everyone across the organization for bringing continued focus and intensity to our mission, particularly during an active Q2 that represented a transitional quarter for us. Before covering the quarter's specific initiatives and results, I want to provide a high-level update on where we've been and where we're looking to go as our transformation progresses. When our board began turning over early last year, GameStop was saddled with significant debt, decaying systems, limited employee depth, and a host of other issues. This is why we spent the second half of 2021 and the first half of 2022 making up for years of underinvestment in modernizing the business. The upshot is we now have a more diversified product catalog, strengthened fulfillment network, improved tech stack and e-commerce presence, and fortified corporate infrastructure. Thanks to these improvements, including our SAP implementation, we're able to start focusing on a new set of priorities that include achieving profitability, launching proprietary products, leveraging our brand in new ways, and investing further in our stores. During Q2, we took steps to support each of these new priorities. With respect to pursuing profitability in the coming quarters, We right-sized corporate expenditures and headcount following a period in which the company had hired more than 600 new individuals. These actions, combined with the elimination of one-time expenses in Q1, contributed to a 14.3% reduction in SG&A. We've done this while improving our e-commerce experience and reducing free shipping to customers to 1 to 3 days. We're going to retain a strong focus on cost containment and continue promoting an ownership mentality across the organization. On the product front, our enhanced tech capabilities allowed us to follow the launch of our digital wallet with the launch of our new marketplace that allows gamers, creators, collectors, and others to buy, sell, and trade NFTs. The launch of our NFT marketplace supports GameStop's pursuit of long-term growth in the cryptocurrency, NFT, and Web3 game verticals, all of which we expect to be increasingly relevant to the collectors and gamers of the future. When it comes to accretive partnerships, we've been actively exploring opportunities to strengthen GameStop's offerings and increase brand visibility. We're building on the momentum established by our previously disclosed partnerships with organizations like Immutable and Loopring, whether it be through new relationships that support our commerce business, blockchain group, or both. The deal we just announced with FTX is a byproduct of our commerce and blockchain teams working together to establish something unique in the retail world. Lastly, when it comes to investing in our stores, we rolled out an improved compensation model for U.S. store leaders. Each of these store leaders is being given a time-based equity grant of $21,000 that vests over 3 years, as well as the opportunity to earn additional compensation every quarter via a performance-based equity grant. In conjunction, we're raising hourly pay for certain store associates. These steps were taken to help us enhance retention and recruitment of passionate, quality talent. When we think about the GameStop of the future, we expect our stores to help us maintain direct connectivity to customers and sustain localized order fulfillment capabilities across more geographies. This is why, even as we continue evolving our e-commerce and digital asset offerings, stores will remain a critical piece of the company's value proposition. Taken together, we believe the optimization steps can help us attain profitability in the coming quarters and produce additional revenue growth over the long term. Let me now turn to our financial results for Q2. Net sales were $1.136 billion for the quarter, compared to $1.183 billion in the prior year's second quarter. Sales attributable to new and expanded brand relationships remained strong. It is also worth noting that sales attributable to collectibles, which is a segment we intend to grow over the long term, were $223.2 million for the quarter, compared to $177.2 million in the prior year's second quarter. SG&A was $387.5 million, or 34.1% of sales, compared to $378.9 million, or 32% of sales, in last year's second quarter. As noted, we had a strong reduction in SG&A on a sequential basis versus Q1 of this year, and we're taking further steps to reduce SG&A on a go-forward basis. We reported a net loss of $108.7 million, or 36 cents per diluted share, compared to a net loss of $61.6 million, or loss per diluted share of 21 cents in the prior year's second quarter. There were no major one-time transformation, transaction, or related costs during the period. Turning to the balance sheet, we ended the quarter with cash and cash equivalents of $908.9 million. We continue to maintain a sizable cash position, even while investing in inventory to sustain strong in-stock levels and mitigate the full impact of lingering supply chain issues. At the close of the second quarter, we had no borrowings under our ABL facility and no debt other than a low-interest, unsecured term loan associated with the French government's response to COVID-19. Total liabilities compared to the second quarter of last year were down $237 the quarter were $20.5 million, up $7 million from last year's second quarter, reflecting investments in our technology and enterprise systems. we anticipate CapEx will remain at modest levels. In the second quarter, cash flow from operations was an outflow of $103.4 million compared to an outflow of $11.5 million during the same period last year. Inventory was $734.8 million at the close of the quarter, compared to $596.4 million at the close of the prior year's second quarter. In terms of an outlook, we're not providing formal guidance at this time. It is worth noting, however, that our ongoing engagement with key suppliers is positioning us to receive stronger supply of next-generation consoles in the months ahead. I want to finish by reinforcing that we're working to accomplish something unprecedented in our industry: transform a legacy brick-and-mortar retailer into a technology-led organization that meets customers' needs through stores, e-commerce properties, and both digital marketplaces and new online communities. Our path to becoming a more diversified and tech-centric business is one that obviously carries risk and will take time. This said, we believe GameStop is a much stronger business than it was 18 months ago. I'll leave it there for this quarter. We look forward to driving more progress in Q3. Thank you.
All right.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.
All right. So I'm going to, recap a few things we heard and then welcome anyone up who'd like to ask a question or share a comment. One of the last things that we heard just there about getting better allocations of hardware, it's obviously important. And I think it's worth remembering, if you're a company that's facing financial going concern issues, there's another meme stock that comes to mind that recently announced a FILO loan to stave those off, that was having vendor issues. But if you're having issues with your vendors and you're a retailer and you're unable to get the right stock on your shelves, it's pretty much a death knell. So it's good to hear the CEO noting that they're expecting favorable allocations heading into the important holiday season when it comes to video game hardware. And I think that that's likely enabled in part by what he noted about the improved balance sheet, which of course comes in the back of the two at the market offerings in 2021. So those are good things. He talked about the stores being used kind of for omni-channel, all-encompassing local fulfillment. Maybe omni-channel is a bad word to use for those who remember Mr. Sherman, but the stores, they do have 3,000 plus US stores that really are close to quite a few households. I don't have a percent radius math off the top of my head, but in-store fulfillment, of course, is always going to be cheaper than a delivery to home. But the company did invest into automated fulfillment centers in 2021 as well, that CEO's noting 1 to 3 day fulfillment. I haven't personally recently experienced any e-commerce order from GameStop. If anyone has, would love to hear that experience. In the past, I would say it used to be if you ordered, say, 5 items, you would get 4 or 5 separate boxes. So hopefully with this SAP ERP implementation, they can start to optimize some of their fulfillment a bit better. But yeah, I would say what we covered before the call kicked off, there wasn't a lot of new information. Obviously, this FTX partnership is interesting, and I think is the primary reason there's a rally in the stock after hours. But it comes with very little detail, and there wasn't much incremental detail provided on the call. I think I heard that it is both crypto and commerce, whatever that means. We'll hear more, I suppose. But yeah, I'll pause there then. And Alpha, I don't know if you had anything to add or anything that got missed that we haven't already discussed.
Nothing constructive. I mean, it's nice to hear Matt Furlong's voice, but it was light on details and no questions. I guess he did answer my question that they'll continue to look at ways to reduce SG&A, but again, light on the details as to how.
Exactly. Yeah. Yeah, he did say look to achieve profitability in the quarters to come, which his word choice of quarters instead of years, I guess, would imply a shorter term than waiting until 2024. But Yeah, I think with GameStop, it continues to be now what? The business's market cap is still, let's call it 8 billion after taking account of after hours. So it's an 8 billion market cap. Let's call it 6 billion in sales that are not profitable today. So the question of what is it worth? I think that is a very huge range of uncertainty still, right? If you're a crypto skeptic and you believe public blockchains are not going to be anything, then you would probably argue that it could likely be a zero altogether, as they are unable to monetize those channels. If that's your viewpoint, even if maybe you're not that extreme in your viewpoint, you may think that this NFT marketplace, which, as I keep noting, it makes a lot of sense to me to embrace digital collectibles if physical collectibles are a big chunk of your business and are a growth vector for you, which is what Furlong reiterated on the call. So it remains to be seen, I think, is how I would walk away from this. I don't personally find the risk reward attractive at these levels. I certainly can see that a lot of people do, and if they end up taking meaningful share in a growing crypto NFT blockchain oriented future, then I could see why people would see the upside. I could certainly paint a picture of that. I think it's just very much uncertainty. I guess that's the one word I walk away with, and the company's lack of clarity in providing certainty is consistent quarter over quarter over quarter. We get some big picture commentary, but we don't really get too much specificity. So, yeah, with all that said, we again welcome anyone who has questions, wants to opine on the results. If you missed the early part, we did note that the 10Q implies that the direct registered share count quarter over quarter grew meaningfully. It grew, I think, what was it, 40% quarter over quarter. It's 71.3 million, which is up from what would be an adjusted 50.8. So, yeah, a 40% increase in direct registered shares. And the first thing you heard out of Furlong's mouth was, thanks to the shareholder base, which, like it or not, it is a meme stock. It has become a meme stock, right? That is not, that's simply an observation of reality. And we've got other meme stocks out there in the universe. And this one, has almost a quarter of its shares now directly registered. And I don't know where that trend will stall out at, or will it continue going up? It has obviously continued to go up quarter over quarter since the company began reporting it. So there's a view, I think, that a lot of those folks have, that there's a large hidden short interest in the stock that by taking that action may effectuate the price increasing. I think that's the general view of the folks doing that. And there's, of course, varied perspectives within that body. Not everyone has that same viewpoint. They may just simply want to register their shares directly for other reasons. I can only speculate. But in terms of the business, it's good to hear what Furlong had to say about the improved allocations of hardware. They obviously can't generate any gross profit if they don't have anything to sell. So that's a good nugget of information. But really, again, very light on details. While he says SG&A will trend in the right direction, what does that mean? I don't know. But yeah, we'll just have to continue to see what happens. They do still have, as I noted earlier, a lot of runway in the form of that 900 plus million in cash they have, and no interest-bearing debt. So as they continue to build out their commerce functionality, their NFT marketplace, assuming again that crypto, yeah, I think nobody knows, right, where crypto goes from here or where NFT goes from here. I think we could all agree a year, 2 years ago, most of us didn't know what that even was. So could it be Beanie Babies 2.0? Could it be the new digital collectibles of the 21st century? Who knows? Again, I think if you're a bull from these levels, you are leaning hard into the crypto/blockchain thesis. And there's just, again, a huge range of uncertainty there. But we hope that hosting this, you were able to hear the earnings call. This has been recorded. If you want to listen back on either Twitter or on Wook Capital's YouTube. This will be available on Twitter for 30 days and in perpetuity until maybe YouTube goes away, whenever that is. Just kidding. On our Wook Capital YouTube. But yeah, I'll pause. It's 5:18. I was going to keep this open until about 5:30, 5:45 if there were questions or comments. If we don't get any, I don't want to repeat myself unnecessarily. I have done that a few times already. There's only so much information one can review. But Alpha, go ahead, sir.
Yeah, I have a question, and this is really more for the benefit of the 300 or so folks listening, unrelated to the earnings call. What's going on with Wook, and what does the future hold? What's in the pipeline, to the extent that you can share?
Yeah. So as I said early on, I mean, the fundamental thesis behind this private investment fund is that collaborating and working constructively with retail investors can yield alpha for everyone. And while we're still very early in our journey, we've moved forward with bringing on support on the social side. Mr. Fonicello is working with me on building out our social strategy, which is still incomplete, but at its core really is trying to drive collaboration, trying to make the dissemination of information accessible for everyone. Again, going back to like specifics of what do I mean by that, like I think about 2020 GameStop, and I think about things like one investor who was more well versed in the legal landscape noting that Brian Cohen's lawyer, when he initially filed his form 13D, was a renowned activism proxy fight, like really serious top-notch lawyer. And when that happened in August, I don't think everyone initially realized that. And those who were made aware of that kind of nugget of information, I think walked away sensing that this was going to be much more serious than just a passive stake or some modest investment. Obviously, and some of the folks listening remember, I used to I became aware in the fourth quarter of 2020 that your e-commerce order numbers from GameStop.com were sequential. So I kind of used that to build a little rudimentary, back of the envelope model, based on basket sizes and anticipated mix, what that would mean for GameStop's financials. And I crowdsourced that information and I published it freely and, let anyone who wanted have access to that. And I think that's the type of stuff that we think, you're going to get some incremental insight beyond just reading a 10Q or 10K or 8K, that deep insight from people who might have expertise in an area you don't. You really want to be part of a community like that. And that's what we're hoping to foster over time. And understand it takes a long time, but I think we're looking to build on our lived experience with that in GameStop and go from there.
So is there a website? Is there a Discord? How can I participate more from a listener?
Right. So we have a beta we're running right now on the Discord side. And for those of you who are in it, we appreciate you participating as we try to get feedback on what the right way to structure the server is to make it valuable for everybody. So that's not yet public, but it will be soon. And obviously this Wook Capital Twitter handle, we will include the Discord link there. You can go to wookcapital.com if you want to read a little bit about kind of the story and the logic and why we've done this. The About Us is kind of our message to that extent, more eloquently put than me on the spot. But it really gets back to, we use this idea of filling in the blanks. And I think that's what it comes down to. We have a view that you want to fill in as many blanks as possible, gaps in your knowledge, things you don't understand, missing data points, whatever. And inherently, if you can get a scaled and systematized approach to filling in those blanks collaboratively, you're going to get better outcomes as an investor, as investors. So that's what we're looking to do. I don't think there are other private investment funds out there doing this or that have tried to do this. We think it's novel. Certainly is no guarantee of success, but we welcome folks to check that out at wookcapital.com. And we certainly will welcome anyone who wishes to join the Discord once we open it up to public.
Awesome. That's really exciting.
Yeah, so it's 5:23. Don't see anyone requesting to come up. I think we really covered about all there is on the GameStop side, but really appreciate folks tuning in and listening. And we certainly will welcome any and all of you who wish to become bookies at some point in time in the future. And we really do think that investing is not a zero-sum game. We truly believe that. And I look forward to hearing more from us. If you haven't already, please follow the Wook Capital Twitter handle. We will continue to be publishing information from the handle on an increasing cadence. Again, our goal is to make information available as freely and as accessibly for retail investors, really broadly. So thank you, everybody, for tuning in. And we hope you have a great rest of your day.